The following video is an extract from the Udemy course, Learn to Construct Financial Statements from the Ground Up. If you would like to purchase the full course, you can do so by using the link below.
Hello and welcome back, and in this lesson we will be getting into the fundamentals now of accounting, and that is the area of double entry bookkeeping. Double entry, a fundamental concept under present day bookkeeping and accounting, states that every financial transaction has an equal and opposite effect in at least two different accounts. And as we discussed in our previous session, it is used to satisfy the accounting equation, which as a reminder is that assets are equal to liabilities plus owner's equity. In the double entry system, transactions are recorded in terms of debits and credits. Since a debit in one account offsets a credit in another account, the sum of all the debits must equal the sum of all the credits. The double entry system of bookkeeping standardizes the accounting process and improves the accuracy preparing the financial statements. Bookkeeping and accounting are ways of measuring, recording, and communicating a firm's financial information. A business transaction is an economic event that is recorded for accounting or bookkeeping purposes. Under the systematic process of accounting, these transactions are generally classified into accounts in the following manner. So accounts can be classified into either assets, liabilities, equity or capital, revenue or income, and expenses. In terms of the first three, these three types of accounts make up the balance sheet, and these bottom two make up the income statement. The next image that I'm going to show you tests out how debits and credits impact these accounts that I've just demonstrated there. This is fundamental to double entry bookkeeping, so it is something, in terms of this next slide here, this is something that just has to be memorized and learned. So in terms of how debits and credits impact the various accounts, this is as follows. So we've got an illustration here. We've got the two primary statements, 2 out of the 3. We've got the balance sheet and the income statement, and then those classifications I spoke to in the previous slide. So I'm just going to work through these now. So in terms of going through each of these, I will start with the balance sheet. So in terms of debits and credits, a debit will increase an asset account. By contrast, then where there's a liability, a credit increases the liability. So a credit to a liability account in the balance sheet increases that liability. And then in terms of equity, that third component of the balance sheet, a credit to a equity account in the balance sheet would represent an increase in equity from the business's perspective. And then to go into the income statement, then if you credit the income statement account for revenue, if a transaction impacts revenue, to recognize revenue, you would credit the revenue account. Whereas if a business needs to recognize an expense, you would then debit the income statement expense account. So that's just something that needs to be learned. We'll go through numerous examples to really just demonstrate the impacts of debits and credits on various accounts. So then, quite simply, for each of those classifications, the reverse is true. If you want to decrease an asset, or in terms of those other accounts, the opposite is true. And this illustration here is important. So I'm going to put in the resources for this session just something to be downloaded and be aware of. So just something that you need to memorize. You'll be seeing this throughout the examples and the interactive workbooks in this course. So you'll be getting lots of practice, but this is just fundamental and something that we need to learn. So what we're going to do, we're going to apply a few transactions and just to really lay down the foundations here. So as I said, these two transactions, you'll have seen these in the one of the previous sessions. We introduced the accounting equations and there was two transactions. We're now going to apply debits and credits to these transactions to demonstrate how debits and credits impact on different economic events or transactions. So you recall in transaction 1, an owner set up a new company and put £10,000 of his own cash into the company's bank account. And then in the second transaction, then the business then purchased £5,000 of inventory, and the inventory is invoiced on credit terms, so there isn't a cash impact immediately. So we're going to illustrate the debits and credits for these transactions. So starting with the first one, where the owner set up a new company. So you will recall the impact of the accounting equation of this. We had, from the business point of view, there's now a bank balance. Bank is an asset, so there was £10,000 of assets recognised. And then in terms of the other impact on the accounting equation, when an owner injects funds effectively into a business, that is impacted through equity. So that was the impact on the accounting equation, which we've gone through. So what we have here, we have got the accounting equation split up into debits and credits for each of those. So if you go back to the pause this video and go back to the previous slide, you'll see that a debit increased an asset, whereas a credit increased liability and a credit increased equity. So this isn't something you would have to write out every time. It just shows the first time you may be going through it. So we just want to really have solid foundations. So this is a way of visualizing it. So we'll go for transaction one. So you'll recall we had an asset was impacted in terms of that bank balance. The business had £10,000 of cash after this transaction. So to do that, bank is an asset, so we would debit bank, and the way debit is shown here in short term is just DR, and you'll see credit in a moment. And the other side of that transaction, as we've seen in the previous slide, was that equity had to increase as a result of this transaction, because a transaction between an owner and a business goes through equity. So in terms of increasing equity, then we'd have to credit equity. So you could say the double entry for transaction one would be debit bank £10,000, credit equity £10,000, and they're both balance sheet accounts in this instance. So going on to transaction two then. So transaction two, the following day, the owner purchased and received £5,000 of inventory that the company will trade. So the inventory is purchased on credit terms, so there's no cash impact immediately. The cash impact will not happen to some point in the future, in 30 days time. So you recall this was a transaction we went through before. So in this case, there was £5,000 of inventory to be recognised, and because we will have to sell that amount of £5,000 at a point in the future, we've got an obligation to do that in 30 days time. The business has to recognise a liability. So to again apply the debits and credits in this accounting equation scenario, where we've demonstrated the impact of debits and credits on assets, liabilities and equity, we will go apply this to transaction two. So £5,000 of inventory has to be recognised. Inventory is an asset, so to increase an asset, you would debit inventory, and then just think we have to recognise the liability on the balance sheet. Then if you go back to the grid I have shown you, to increase, and you'll see it here, to increase a liability, you need to credit that liability. In this case, it's a trade payable. So the double entry for transaction two would be debit inventory £5,000, credit trade payable. And just to show you then how debits and credits always should sum to zero. In this case, we've got £15,000 of debits in terms of the assets. We've got a credit of £5,000 and a credit of £10,000. So our credits sum to £15,000 and our debits sum to £15,000, so they equal each other. So that's key. So once you've got your debits and credits, accounting then needs to choose a shorthand or a standardized way of presenting double entries, and that is done through the accounting journal. So we've got the journal here of transaction one. So this is a typical format of a journal. Debits will always be on the left hand side, and then credits will always be on the right hand side, and that's typical then. So that is just a known or a constant in accounting. In terms of the journal, the debits would form the left and the credits would form the right. And then in terms of then you would have the debits and credits here, and then you would write the account over here. So in this case, as we demonstrated, the balance sheet, both of these accounts are balance sheets accounts. So you would put the account here, or as we have done, then we'd have a form of narrative then, just if it's good practice, to a brief description of what that journal is reflecting in the financial statements. And then finally here, this is just a note for teaching purposes to illustrate the impact of what these debits and credits are doing. So the debit here is increasing an asset, whereas the credit here is increasing equity, as we demonstrated in the previous slide. So that's the journal for transaction 1. Similarly, for transaction 2 then, the journal forms the same basis in terms of with the debits on the left and the credits on the right, and then that's how we would reflect the journal 2 then, and again these are both balance sheet accounts, so that's just taking the same format here. Just in this case we have ignored the impact of VAT, just to show something to be aware of. So that is the journal, so now I've introduced that to you, that's something just to be aware of. And now just to suppose for transaction 1 and 2, I'm going to demonstrate what the balance sheet would look like as a result of transaction 1 and 2. So this is just a simple extract of the balance sheet here. So assets, liabilities and equity. This is just transaction 1, the 10,000 cash being recognised, cash at bank, and then the owner's capital was also recognised here. And then in terms of transaction 2 with the inventory and then the trade payable, that's just how it would look like. And what I do want to draw your attention to in this slide is that at this stage the income statement has not been impacted as a result of transaction 1 or 2. So in transaction 3 then we're going to introduce to you, we're going to demonstrate how the accounting equation is impacted when a transaction does impact the income statement. So as I said, transaction 1 and 2 has impacted the balance sheet only. So how does the accounting equation stay in balance when the income statement is impacted? Profits or losses form part of an organization's equity, and that equity component of the accounting equation. So we'll demonstrate this by way of an example. So just as a recap, in transaction 2 we bought 50 units at £100, so that gives us our £5,000 of inventory. So transaction 3 then, the company sells 25 units at a selling cost of £134 per unit, and in this case the customer is going to pay the company in 15 days time, so that cash has not been received immediately. So just to be aware of that then, the accruals concept is coming into play here. So just quite simply, we've got 25 units at £134. So just summing that up then, that is £3,350 is the revenue to be recognised in terms of a sale being made. So a revenue or sale can be used interchangeably, and that will impact the income statement. And then there was a fundamental accounting concept called the matching principle. And the matching principle states effectively that when revenue is recorded, the related expense in making that sale has to be recognised at the same time. So in this case, the purchase price of the inventory was £100 per unit, as you recall in transaction 2. So because we sold 25 units, we have to recognise the cost of those 25 units. So this is the matching principle in practice here. So the cost of those 25 sales was £2,500, and then that's the selling price, and now we can go on to recognise our accounting profit. So transaction 3, so we've gone through transaction 1, transaction 2 you should be aware of, which we've just gone through. I'm now going to speak through the impact of transaction 3. So the first thing we said that needed to be recognised was that sale of £3,350. So to recognise the sale, transaction 3 is the first transaction that does impact the income statement. So we have to recognise the sale of £3,350, and in terms of the balance sheet impact, this is an asset in the form of a trade receivable. So you'll recall we didn't receive the cash up front. If we did receive the cash up front, we would have to recognise the cash here. But because we will be recognising the cash in 15 days time, we haven't actually received that cash. We've sold that item on credit terms, so 15 days. So we will be receiving an economic benefit in 15 days time. So that is an asset to be recognised. So that's how we account for the sale. And then in terms of then the cost that we have to recognise under that matching principle under accounting, the cost of the sale, as we've calculated above, in this instance would be £2,500. So what we have to do then, we have to recognise the cost of that sale in the income statement. And then what has happened, we've actually sold inventory here. So we have to recognize that the inventory has decreased. That is a decrease in an asset. So we then have to reduce that asset by £2,500. So that's what we are going to do. And then in this case, there is a profit of £850 in this transaction. So this one does impact the income statement effectively. So just to then, the closing impact of after transaction 1, 2 and 3 is here. So this is the sum of these previous three columns effectively. So in terms of the accounting equation, we have got the accounting equation is our total assets is 15,850, our liabilities are 5,000, and then our equity is 10,850. And you can see here when I said before that the income statement effectively is recognised within retained earnings. So the closing retained earnings is the accumulated profits or losses. So this is just a way of demonstrating how profits are reflected within the equity within that accounting equation. So then we have illustrated that in the financial statements. So now we're going to construct the journals for this transaction 3. So again, there was two components to be recognised. There was the recognising of the revenue and then recognising the associated cost of generating that revenue. So again, we're going to go back to our trustee table here, which illustrates the impact of the debits and credits on the various balance sheet and income statement items. So if you want to pause this now, I'm going to go through the solution. But in terms of we're going to construct the two journals for those transactions. So if you want to pause it now really quickly and try that, I'm just going to continue with it now. So what we had to do in terms of the sale of 3,250, just before we go into that, we have to recognise revenue here. So to recognise revenue is a credit. So we would want to credit revenue £3,350. And then the other side of that transaction was we had to recognise a trade receivable, which is an asset. So again, that would then debit the trade receivable in the balance sheet. So that is the first component. So our journal for the recognising the sale, as we said, is debit trade receivables, credit revenue, and that is reflected in this journal. And then recognise the corresponding cost then, so the 25 units at £100. So we have to recognise the cost and then the reduction in the inventory. So to recognise the cost is an expense. So we're going to increase an expense. We have to increase this expense, which is a debit. So we're going to debit the expense £2,500, and then we have to reduce the asset here because we've sold an inventory. We want to reflect that in the books of the business. So we're then going to credit inventory £2,500. And you'll note here our debits are equal to our credits, and that is always should be the case in accounting. So the journal for this cost element of this transaction is set out here. Debit or expense or cost of goods sold £2,500, and then credit inventory in the balance sheet. So that's the journals there for transaction 3. So that's all good. And just to then close this off, I'm going to show you how our accounting equation in the balance sheet is impacted by transaction 3. So in transaction 3, you will recall we've recognised the trade receivable of £3,350. We had to reduce the inventory, which was the other balance sheet component, and then effectively that profit we said was £850. And when a profit is impacting equity, that actually increases equity from the business point of view. That's a favourable movement. That's the owner of the business has made profit. I suppose the business has made profit, which is ultimately owed to the owner. So profits are an increase of equity, and to increase equity is a credit. So again, to tie off so the debits and credits equal each other, we're satisfying that because these sum to 0, and then our profit then is accumulated. Our profit is accumulating within owner's equity, as we said as well. So to then look at our totals then, so our debits for the assets, we sum them up, it is 18,350, and then the credit for asset was that inventory. So we'll add those two together in a moment. And then just to go through to finish off each of these sums, we had the trade payable being 5,000, and then our equity is 10,850. So we take all our debits less our credits, so our 18,350 minus the credit to give us a net debit of 15,850, and then we add these two together again. You can see the accounting equation is still in balance, and our debits are always equaling our credits here. So that's just a good control within accounting, so that's embedded into the accounting process. Okay, I'm going to, before I go into this video, I'll probably just break this up, I suppose, just so we're in so short, relatively short videos. So I will see you over in the next video, where I am going to show you how the trial balance is extracted to form the financial statements. So I will see you over in the next slide shortly. Okay, welcome back. In this session, we finished off where we had, if you would recall, we had the accounting equation satisfied for this account, for these three transactions rather, I should say. So what we wanted to do is show the process of how journals make the trial balance, and then how the trial balance forms the financial statements. So we're just going to show you that just to finish off this transaction. In our next video, we're going to really go into trial balance in a little bit more detail. But just for now, what a trial balance is a bookkeeping worksheet in which all the balances of all the ledger accounts are compiled into debits and credits. So that's effectively what the trial balance is. So an extract of the trial balance is here. So you will recall in the previous video we had transaction 1, transaction 2 and transaction 3, and those various debits and credits has been reflected here. So just to be aware of, typically a credit will be represented by a minus figure. So you can see here that all of our debits and credits are summing to nil for every transaction. So if you want to go back to the last video, if you have to, this was transaction 1 where we recognised the bank and the corresponding capital injection by the owner. Transaction 2 was we purchased inventory on credits, we had to recognise the asset and the liability. And then in transaction 3, we had to recognise the sale, we had credit revenue, debit trade receivable, and then we had to recognise the cost, the 2,500, by debiting cost of sales and crediting inventory. So the trial balance, I suppose, the journals are reflected in the trial balance to give us a closing trial balance then, which will form the financial statements. So what we're going to do here now, if at this point we were to illustrate the income statement and balance sheet from that trial balance we just constructed, it would look something like the below. So we've got our balance sheet here, and we've just taken the closing balance from each of those previous amounts. So inventory was 2,500, debtors was 3,250, and cash was 10,000, and those were all debits. So again, if we just go back to the previous slide, those are the amounts I was speaking about. So again, we're just introducing you to the trial balance here. Throughout the duration of this course, you will be constructing journals and doing this bit by bit, but I suppose we're showing you what we're getting towards. And then our trade payable is £5,000, so you'll see that in this balance sheet here. So that's just effectively the trial balance records the transactions through debits and credits. There's a closing trial balance which is constructed, and then the trial balance forms the balance sheet and income statement. So if we go to our income statement now, again, this is just taken from the trial balance. So turnover was 3,250 and the cost of sales was 2,500, and those were debits and credits. So again, if we just go back to our closing trial balance, there is our minus 3,350, and again a minus represents credit, and the debit was £2,500. So we can see that in our income statement and balance sheet. So that is how the trial balance is reflects or makes up the financial statements. Now, just one final thing before we go on to our next session I want to draw your attention to. So you're now aware that credits in the income statement effectively corresponds to turnover or revenue. So just think when we see turnover here, that we refer to as revenue or sales, so don't get put off by that. So you are aware that in accounting, a negative figure represents a credit, and a credit in the income statement is used to recognise a sale. But for somebody who was looking at the financial statements and seen sales as a negative figure, and seen this negative figure, that might look quite confusing, to be honest. So what accountants do when we are constructing financial statements for this balance sheet, we just represents the sales as positives and expenses or cost of sales as negatives. So I'm just going to demonstrate that now. So as I said, it can be confusing to have negative numbers in the income statement as I've set out. So for presentational purposes only, revenues will be shown as positive, and then expenses and costs will be shown as negatives. So if we look at our income statement now, where we were actually pulling together a set of financial statements, then we would suppose deviate away from your credits and debits. We want to actually show that turnover is then positive. So there's just a that process there of revenues being shown as positives and expenses being shown as negatives then is just so the final step in preparing financial statements. Just so that's a little bit that's more intuitive. As a result of this transaction, we had a profit of £850, so it makes more sense to have that as a positive. So just when we're constructing our financial statements, just bear that in mind, that we don't want to have our sales or turnover as a negative figure. And then in terms of our balance sheet, then that is pretty much similar. The only difference from our previous debits and credits and financial statements was that equity is effectively, if it's a favourable, it's credit, which is a negative. So we just change these to positives as well. So that's just something I want to draw your attention to. So hopefully you found that process useful. Again, you'll be getting lots of practice at this, and when we introduce you to our the interactive workbooks, where you'll be constructing a set of financial statements from the ground up. We've probably covered a little bit of ground there. So if you do need to go over the previous video and this video, please do. Just take time to absorb the concepts. But again, we will be reinforcing these as we continue throughout the course. So just by way of recap, double entry bookkeeping is a way of reflecting transactions in the financial statements. Double entry states that every financial transaction has an equal and opposite effect on at least two different accounts. In the double entry system, transactions are recorded in terms of debits and credits. Since a debit in one account offsets a credit in another, all the sums of all the debits must equal the sums of all the credits, as we have demonstrated in the transaction 1, 2, and 3. The impact of debits and credits on the accounts within the financial statements is reflected below, and this is something that quite simply you just suppose need to memorize. And again, the more practice you get, the more familiar you'll be with the impact of debits and credits on these key financial statement items. Finally, it can be confusing for various stakeholders or various users of accounts to have revenue as a negative on the income statement. So typically on the income statement, for presentational purposes, revenues will be shown as positives and then expenses will be shown as negatives. So just something to be aware of. So again, you'll be getting into the examples of these interactive workbooks, which I think will really consolidate the learning. So just dwell on that. As I said, the videos are there just to reinforce anything I have gone through in terms of the transactions 1, 2, and 3. So once you've had time to absorb that, I will see you over in the next lesson. Thank you.